It's really tough to get money from a bank for a mortgage right now. So should I skip the banks and go straight to a non-bank lender? Hi, I'm Ed McKnight, economist here at Opes Partners, and in today's video, you're going to learn whether you should skip the main banks and go straight to talking to a non-bank lender. Now, if you don't know what a non-bank lender is, it's time to get well acquainted. They are businesses that lend you money to go and purchase a property, your first home, or an investment property, but they're not like the main banks because they don't offer term deposits or credit cards, and they're not registered with the Reserve Bank. If you want to find out all about them, we have recorded a full video for our YouTube, and you can find that down in the description. Now, in terms of deciding should you use a non-bank lender and skip past the main banks, the first step is always to talk to a mortgage broker, and they will help you figure out question number 2, which is, can you get finance with a main bank? Now, if you can get finance from one of the main banks like an ANZ, an ASB, a BNZ, then it's usually the right decision to go with them. The reason we say that is their interest rates tend to be lower, and we'll go through the reasons why that's the case in a moment. But if you can't get the money, if they won't approve a mortgage for you through one of the main banks, that's when it's time to start looking at those non-bank lenders. Now, there are a few other steps in this, but I'll take you through them later in the video. Now, if you're looking at this, you're probably wondering, well, what does my ability to get money, to get a mortgage from the main banks depend on? Well, it all comes down to risk tolerance from the bank's perspective. So you can think of their willingness to lend from a scale of lower to higher. Banks tend to have a lower risk tolerance. That means they're less willing to lend to risky borrowers. Whereas non-bank lenders, on the other hand, tend to have a higher risk tolerance. They're more willing to lend to borrowers who are a little more stretched. Now, this comes into the cost that they charge. So banks tend to cost less, but they also have a lower risk tolerance. They're less willing to lend. On the other hand, non-bank lenders tend to cost more, but they're more willing to lend money to higher risk borrowers. And you can see here that there is a range of non-bank lenders. Some are willing to lend to very high risk borrowers. They charge more. Others, lower risk tolerance, and so a little bit lower cost than some other non-bank lenders. And just to give you a sense of what those interest rates might be, let's start by looking at the 1-year fixed interest rate at ANZ. Right now, that's 3.65%. Well, if we look at Resimac, which is quite a popular non-bank lender, their lower risk loan, what we call a Resimac full doc, is currently 4.24%. So about 0.6% higher interest rate than the main bank. Now, if you look at their even higher risk product, it's another 50 basis points higher, 0.5% higher, 4.74%. So you can see how the interest rate starts to increase based on the risk that you pose to that lender, whether it be a non-bank or a main bank. But now you're probably thinking, well, Ed, how do I know if I'm a risky borrower or not? How do I know if I pose more risk to a lender? Well, I've got 4 factors for you just to consider to figure out, well, where am I on this spectrum? If we're thinking about borrowers who pose less risk, then your debt to income ratio might be under 6, whereas if you pose more risk, it might be over 7. If you've got fewer properties and less debt, you're probably lower risk, whereas if you've got a lot of properties and a lot of debt, you're probably going to be seen as higher risk. On the other hand, people who tend to be lower risk tend to have very clean credit, whereas people who have lots of missed payments, who constantly go into unarranged overdraft, they tend to be higher risk. And if you've got very strong, especially provable income, then you're going to be lower risk. Now, what do we mean by provable? Well, if that money's coming regularly and hitting your account like a salary or wages, that's provable income, whereas variable income, which poses more risk, that's things like if you get a lot of bonus income, you earn a lot of commissions, or you've owned your own business for less than 2 years, that's where you'd have less provable income or weaker provable income most of the time. Now, all of those that are on your left, those things that make you lower risk, that would tend to suggest that, hey, you might be able to go to a main bank, whereas those on your right, the ones that are higher risk, those are non-bank indicators, indicators that perhaps a non-bank might be the right fit for you. Now, I've had a couple of investors reach out to me recently and they've been asking, Ed, should I ever just go straight to a non-bank? And the answer is yes, some of the time. And the reason I say that is that non-banks, because they're smaller, because they don't have as much regulation, though they are regulated, they can be more innovative. So they tend to come up with specific products that work for, say, investors or first home buyers. Now, I want to take you through two examples of what these products are, just so you can fully get your head around it. We're going to start by talking about the 80/80 loan, which is by a company called Resimac. And then we're going to talk about the ability to finance against value, which is offered by a non-bank lender called Avanti. Let's start by talking about that 80/80 loan. Now, if you want to go and purchase a property, you can generally borrow up to 80% of the value for your own home and up to 60% of the value for an existing investment property. This is what's been laid down by the LVR restrictions by the Reserve Bank of New Zealand. But if you work under the 80/80 loan by Resimac, they will lend you up to 80% of the value. They'll give you an extra 20% of the property's value for an existing investment property. Now, what does that practically mean for you as a property investor? It means you can purchase existing properties with a lower deposit than would otherwise be the case if you went to a main bank. Now, there is a bit of a catch. You've got to have both your own home and the investment property with Resimac for this product to be approved, but this can be a really good option if you've got tighter equity, don't have as much deposit, but have really good income. Now let's talk about the other product, the finance against value, which is offered by Avanti. And this is really good for people who are investing in new builds, especially over the last 2 years from 2020 onwards, where we've seen house prices increase. So if you want to purchase an 800K new build from a main bank, they will lend you up to 80% of the value, subject to their criteria, of course. That means they'll lend you 640K against that investment property. Now, what happens if, like over the last 2 years, property prices have increased and by the time you come to pay the money for that new build, it's actually worth $1 million? What would a main bank do? How much would they lend you? Still 640K, because they're only going to lend you against the value of your purchase price, not what that property is actually worth. Now, if we think about Avanti or some other non-banks who do this as well, they will lend you based on the current value, the $1 million valuation that you've got for that new build. Now, that means you can borrow 800K in this scenario. Now, this is a lot of numbers, but what's the crux for you? What does that mean for you as an investor? Well, if you use that product, you can potentially purchase a new build property, settle a new build property if it's increased in value like this, without a deposit, without needing to tip in an extra deposit. And what that means is you're able to grow your property portfolio more quickly than you otherwise could. Now, of course, there are additional charges, there are high interest rates of taking that option, but it could be something that you might like to think about or talk about with your mortgage advisor because it can be really beneficial, especially for investors at the start of their journey. Now, we will do a full video in the future about all of the different non-bank lending products because we've only gone through 2 today and there are so many more. But the reason I wanted to show you these is because it changes the process diagram. This idea about which should I use, a bank or a non-bank lender? Well, step 1, always talk to a mortgage broker, and I'll tell you more about that in a moment. Step 2 is now, is there a non-bank product that you want? If there is, if you want to use an Avanti loan against the value, or you want to use the 80/80 product, then that's where, even if you could get approved by a main bank, you might skip past them, go straight to the non-bank because there's a specific product you want, a specific loan structure you want. But if there's not one of those products, then you ask yourself the same question we talked about earlier, can you get finance from a main bank? If you can, generally, go see your main bank. If not, that's when you'd start talking to a non-bank. Now, pop quiz for you. Let me ask you this. Which of these steps do you think is the most important of this? If you said talking to a mortgage broker, you are absolutely right. Now, why would I say talk to a mortgage advisor first? Well, there are 2 reasons. First of all, you probably don't know all of the non-bank products that are available and on the market. You might not know whether there is a better mortgage product that might be available for you in your situation. So talking with a mortgage advisor who understands all of these things can be so beneficial. The second reason we suggest that is that with quite a few of the non-banks, you can't just rock up and apply yourself. You need to use a mortgage advisor who's got that relationship in order to secure the lending for you. So again, some of those non-bank lenders will only approve your mortgage if you've got a mortgage advisor. So talking to them, figuring out what's the right fit for you, answering that question, can you get finance with the main bank? That's why it's so important to talk to a mortgage advisor first. And if you're looking for a recommendation for a really high quality mortgage brokerage, mortgage advisory company that's got relationships with non-bank lenders, then you might like to check out Catalyst Financial. These are our in-house mortgage brokers here at Opes Partners. We sit in the same offices with them and we can vouch for their quality.